you're really saying is there are three sets of prices. The first set is, which is the standardized format of calling what we call is face value, which could be ideally rupees 10 is the way we define
1, 100.
10. That is the face value with which the company starts off.
That's right.
When it makes an issue, the IPO, it could be at a certain price, as you said, which would obviously typically be above the face value. Right? Why would a company do it below the face value? And then when it gets listed, so to speak, and I want you to explain this a bit more, the whole process of how it works. Yes. But when it gets listed and on a daily basis it ends up getting traded, that's the third price. These are the three different set of prices that one looks at.
Absolutely.
So this whole process, Chitra, from the time that a company decides that this is my face value of my share, I want to go public, and then it gets listed and traded, how would you explain that to our viewers?
Sure. There's also one more nuance on the face value, which we should, which is where it is relevant. So I may want to put 1,000 rupees into a company, and so the 1,000 rupees is in the form of a number of shares, right? Now, if the face value is 10 rupees, this comes out to be 100 shares, which is what translates into the 1,000 rupee investment. So I hold 100 shares of company A. If the face value is 1 rupee, then I'm holding 1,000 shares of company A. So that is perhaps the one implication there is of the face value of a share. It actually helps you figure out how many is the quantity of shares that you're holding in a particular company. Now, as you said, a company, let's say, goes out and makes an IPO or makes an issue of capital. When it makes an issue of capital, it will have some advice on what sort of premium, if I may call it that, which is the value above the par or above the face value at which it is able to raise money from the public. The IPO typically happens during a period, that means the company keeps this issue open for a particular period of time through the stock exchanges, and people can actually apply and get shares of that company in an IPO. So you may subscribe to shares and you may get this 100 rupee share when you subscribe to the IPO. Once the IPO is over, that means the offer is over, the company allots these shares, and once they allot the shares, if you get an allotment, then you become the holder of that number of shares. If you really need to be able to come in and out of these shares, you need a market, which is where the company comes and lists it on the stock exchange. So the listing on the stock exchange provides the investor a mechanism by which every day he is able to, in a sense, look at the value of what he has, as well as gives him that exit mechanism if he wants to get out of the share. So the day the company lists on the stock exchange is the first day that a price will get set on the market for that company.
Are you saying, is that where the word or the term premium comes from? That when you said 10 rupees might be my face value, but my issue price is 100. Does that mean, or that is how we understand when you say it's at a premium of 90 rupees? Because it's 90 plus 10, so final price is 100. That's how you define the premium.
Exactly.
And then similarly, when it starts trading, it could trade above the issue price or it could trade below the issue price.
That's right.
And what determines this? What determines the post pricing or even the pricing of an IPO in that sense? I mean, is it about the company saying, I see value at this price, and then when you move to the stock exchange, how does it get determined? Why is one share up and why is one share down?
When a company, for example, arrives at a price of 100 to make an issue to the market, the merchant bankers and other valuation experts for the company will actually do a due diligence to see what is the value of assets, profitability, etc. And they will also look at what is the potential in terms of forecasts. Okay, how well can this company potentially do? Then they will look at, for a similar industry, if there's already something like that, how is the shares of that similar company trading in the market? That gives them a sense of what is the sort of, price earnings that exists for that industry. It gives a sense of what people are willing to pay for future profitability. Right? So that is what guides them in determining a value. It's also a function of many other factors. For example, what is the current market cycle? Is it, well, so-called the economy is doing well, so everything is looking up, so you find asset prices therefore reflecting that optimism? Or is it that industry is going through a rough patch?
Okay, let's take an email that has come for you, Chitra. Rajiv from Delhi has written to us. He wants to know what benefits will he get as a shareholder of a company and what are the risks. Now that's the most important part really, because one is, of course, I would like you to answer first the bit about what are the benefits. Why should I be a shareholder? I can understand that a company wants to raise money and therefore wants to spread the wealth across to many people. But what are the benefits for me? One, of course, would be the price differential. But are there any other benefits I get as a shareholder?
I think the key thing to remember is when you're a shareholder of the company, you're actually like the co-owner of the company. And so you have the upside on all the returns as well as the risks. The two are related. Now, what are the returns that a shareholder can usually sort of look forward to? First, of course, is the dividends, which is in the form of a annual distribution that a company will do of its profits to the shareholders. So that's like a revenue stream that you can look at for holding shares. Second, sometimes the company may also offer, let us say, a preferential subscription to future capital. You also have a right, as in being an existing shareholder, new capital has to be always offered to you first. Third,
that's what we call a rights issue.
That's right. That's what you call a rights issue. And thirdly, sometimes the distribution of profits may not be in the form of money as in dividend. It may be in the form of additional shares given to you, which is what is called bonus shares.
Bonus shares.
So these typically could be the common income that you can have from holding equity shares. The risks, of course, is the fact that as an equity owner, your capital is at stake if the company doesn't do well. So there is no guarantee that if you invest 10 rupees in a company, that 10 rupees has to be repaid to you by the company. There is no such commitment. This is risk capital.
We are discussing equity markets with Chitra Ramakrishna, Joint Managing Director of National Stock Exchange. We'll be back right after this short break. Keep watching The Informed Investor.